Personal versus corporate tax in 2025. What Canadians need to know. Are you earning income through a corporation or wondering if it makes sense to incorporate your business or investments? Understanding how personal and corporate tax integrate and sometimes don't is essential in 2025. Welcome to the channel. My name is Anthony Gismondi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. Earning investment income in a corporation. If you hold investments inside a corporation, that income is taxed twice. First, at the corporate level when the investment earns income, then again, personally, when you take the money out as a dividend. Now, in theory, this double taxation should even out. It's a concept called tax integration, but in practice, that integration is imperfect. And depending on the type of income and where you live, you could face either tax deferral benefits or tax costs. For Ontario in 2025, here's how it looks. For regular investment income, the top personal tax rate is 53.5%. In a corporation, it's taxed at 50.2%. That gives you a 3.3 deferral advantage if you're not taking the money out right away. But when you do withdraw it as a dividend, the combined tax jumps to 57.9, which is actually 4.4% higher than earning the income personally. Translation, if you plan to hold investments long-term inside a corporation, there's some deferral benefit. But if you're drawing that income out soon, it may actually cost more in tax than holding the investment personally. Now let's talk business income. When you earn active business income through a corporation, you have a couple of options. You can pay yourself a salary or pay dividends, and the choice matters. In Ontario, if your business qualifies for the small business deduction, the corporate tax rate is just 12.2%. Compare that to a top personal tax rate of 53.5%, and you've got a significant tax deferral opportunity, over 41% if you leave the money in the business. But when you pay out dividends, the integration kicks in again. And just like with investment income, the final outcome may include a small tax cost, roughly 0.6% to 1.9%, depending on the dividend type. So if your plan is to reinvest in the business or delay withdrawals, incorporation can be a smart strategy. If you're pulling the money out quickly, the tax savings shrink or may disappear. Let's not forget the personal side. For 2025, the TFSA limit is $7,000. The RRSP limit is $32,490. And the RESP contribution of $2,500 earns the full Canada Education Savings Grant. And if you're drawing CPP, the maximum monthly benefit ranges from $917 a month at age 60 to $2,034 a month at age 70. OAS is up to $727 a month and starts to get clawed back once your income exceeds $93,454 annually. Capital gains still taxed at 50% inclusion rate for now, but let's keep your eye on 2026. That's when the proposed 2/3 inclusion rate may kick in for large gains. That could have a big impact, especially if you're realizing capital gains inside a corporation. Quick tax numbers on tax brackets in Ontario. $100,000 in income, your average tax rate is around 22%. But your marginal rate, what you pay on the next dollar, is over 31%. At $250,000 in income, your marginal rate jumps to almost 50%. This is where tax planning really matters. Small changes in how and when you take income, whether personally or corporately, can make a big difference in what you keep after tax. Final thought, strategy before structure. The best way to use this information, start with your goals. Are you reinvesting, saving for retirement, or planning to exit your business? That will guide whether a corporate structure, personal investments, or a mix of both is right for you. And as always, work with a qualified tax advisor, especially if you're managing corporate and personal income together. A little planning today can save you a lot in the long run. If you found this helpful, hit that like button, Subscribe for more investment tips and drop a comment below.